Hello and welcome, ladies and gentlemen. My name is Sameer Shah, and I'm an M&A partner in Khaitan's corporate M&A group. Welcome once again to this 8th edition of our M&A Academy program. We are nearing the end of our program for this year, and we do feel that it has been received very well. Our registrations have progressively increased with each webinar, and today we are at an all-time high. The M&A Academy, as you know, provides foundational legal knowledge and understanding on M&A transactions and processes to corporate executives, in-house legal teams, and other M&A ecosystem participants, and all of it in a corporate-style training environment. Our subject today is the framework for public M&A in India. Virtually all of our earlier webinars in the M&A Academy have focused on private M&A, so we thought we should do a session on public M&A because it is an extremely important part of the entire M&A universe. If you're interested in M&A, you have probably read in all of the economic dailies about public M&A deals, especially the larger ones, which are always in the public arena for one reason or another. Recent examples include Adani's acquisition of ACC or Reliance's acquisition of Just Dial. To understand what is happening in these deals, you really need an understanding of the basic framework in India, subject to which M&A deals in the public space are transacted, and that is the purpose of this webinar. It is really in a public listed environment where the regulations are quite prescriptive and detailed, and as is apparent, creativity in deal structuring tends to be inversely proportional to the extent of regulation. These aspects of deal making in the public space are what we will attempt to cover today. As always, we do have a presentation, and post the presentation, we will have a Q&A session with audience questions. We have already received several questions as a part of our registration, and please continue to submit your questions using the webinar portal. As always, we will attempt to respond to whatever we can today, else we will respond offline over email to the questions we cannot address in the webinar itself. We will also send the presentation, certain summary notes, and a recording of this webinar to you afterwards, and we will also upload the recording on YouTube. Remember, please, that you can see the recording of this webinar along with all earlier M&A Academy sessions on Khaitan & Company's YouTube channel. To introduce our speaker for today, we have with us Abhishek Dadu, who is an M&A partner based in our Mumbai office, although he works on projects nationally. Public M&A is his calling, and he has more than a decade of experience of doing just that. We circulated his profile over email to everyone who registered with us, and you may have seen that he has advised on many high-stake transactions. But if you ask him, we would call out Reliance's acquisition of Just Dial and Thomas Bravo's acquisition of Majesco as his most interesting recent deals. So without further ado, I now invite Abhishek to deliver his presentation. Abhishek, over to you.
Thank you, Sameer, and thank you everyone for joining. Public M&A is one of the most interesting and complex components of the M&A universe, and one that often intrigues the media and the corporate community at large. The reason public M&A receives a lot of attention is because there are thousands of companies across several sectors listed on Indian stock exchanges, including some of the largest and most profitable companies. And invested in these companies are millions of public shareholders. For example, Reliance Industries, one of India's largest companies, has issued more than 3 billion shares to more than 3 million public shareholders. So you can see how public M&A impacts not only the contracting parties, but also the securities market and millions of public shareholders. Some of the recent public M&A deals, as Sameer also mentioned, were Reliance's acquisition of Just Dial and Adani Group's acquisition of Ambuja Cement and ACC. In this presentation, we intend to provide a high-level overview of the public M&A regime in India, focusing primarily on takeovers. Tribunal-approved mergers, asset sales, and tax considerations are not intended to be part of this presentation. However, we have done a separate master series on tribunal-approved mergers, and if that is of interest to you, you can separately see that. Next slide, please. The agenda for us today is to run through, of course, the framework for public M&A, the various regulations, commercial considerations that come into play, the differences between private and public M&A, key characteristics and features of a mandatory tender offer, their timelines, their preparations, certain key principles in relation to insider trading, withdrawal of open offers, and ultimately hostile takeovers. Next slide, please. The public M&A regime deals with acquisition of listed companies, which have two broad classes of shareholders. The first being the promoters, which are the controlling shareholders, and the other being the public, the passive shareholders, for instance, retail investors like you and I. Usually, the promoters have control over the board and majority voting rights. And through such rights, they are able to exercise control over the operations and management of the company. A public shareholder, on the other hand, does not interfere in the operations and management of the company on a regular basis. Instead, they rely on the board and the promoter to act in the best interest of all stakeholders. Given this divide between a public and private shareholder category, several SEBI regulations have been formulated to bring about greater degrees of transparency and to protect the interest of public shareholders. Next slide, please. The regulatory regime for public M&A comprises primarily of the Companies Act and various SEBI regulations. These include the Takeover Code, the Insider Trading Regulations, the Issue of Securities Regulations, and the Listing Regulations. In brief, the Takeover Regulations deals with the acquisition of substantial securities or voting rights or control in a listed company. And if you were to do any of these, it results in triggering a mandatory tender offer. We will deal with each of these concepts a little later in our presentation. The Insider Trading Regulations deals with communication of unpublished price-sensitive information. This is really the heart of a listed company. Information about its future projections, its business plans, the decision-making points which drive an investment. And sharing of this information needs to be highly regulated. The Companies Act and the Issue of Securities Regulations deals with any primary or secondary acquisition of listed companies, including the minimum price at which these can be done. We will deal with this in some time as well. The listing regulations deals with various disclosure obligations and governance related rights. Public M&A also has a unique commercial characteristic in the form of its pricing. To explain, in a listed company, the price is dynamic. As you're all aware, the price of a listed stock can move up or down. Next slide, please. So let's take an example. Say a company wants to do a primary issuance. In that case, the price or the minimum price at which a listed company can do a primary issuance is linked to its historic market price. So for example, if an agreement to sign the contract is to be signed on a particular date, you would look back at the trading price for the last 10 days or the last 90 days, and whichever is the higher, the volume weighted average of the higher of the two is taken as the base price. Now, this is of course not the case in private company deals where you have a fixed price, but in listed companies, because the price is dynamic, the market price plays a very important role in deciding the final price at which parties can agree to. We will come back to this slide in a little more detail to analyze how this dynamic pricing can impact a public M&A deal. But for now, the key takeaway that we have from this background is that the true mantra for a public M&A deal is confidentiality and speed. Confidentiality is of utmost importance because if information about a transaction leaks in the market, then the market reacts. It could either result in the stock price going up or going down. If the stock price goes up, then you can have a situation where the deal becomes unviable. Just to give you a flavor of how dynamic pricing is, you have a graph, and this is a real graph of a listed company. You see that on the 1st of February, the price is at 47 rupees. And just 10 days later, on the 11th, the price has doubled. Therefore, the pricing is highly dynamic and can result in substantial fluctuation and maybe even impact the existence of the deal itself. Next slide, please. In its simplest form, public M&A refers to the acquisition of securities or voting rights in a listed company. If this acquisition of securities or voting rights is above a certain threshold, for example, if it's above 25%, then the acquirer of the shares is required to make a mandatory tender offer for a minimum of 26%, whereby the acquirer offers to the public to buy a minimum of 25% of the total public float. Now let's understand this with an example. Let's say Mr. Apple enters into a contract to transfer control of a listed company to Mr. Orange. Since Mr. Apple as a seller is now transferring control to Mr. Orange as a buyer, all the public shareholders in the listed company now have the option to sell their shares to Mr. Orange, who's the buyer, at the same price that is being received by Mr. Apple as the seller. Now, the obvious question that comes up is, why do we have such laws? Why do you have a regulation which talks about a mandatory offer being provided to public shareholders? The rationale for this is twofold. The first is to protect the interest of the public shareholders. Now, let's take an example. Let's assume that Mr. Apple and Mr. Orange have entered into a contract to buy shares of the listed company at 100 rupees. And let's also assume that the market price of the stock at that point in time is 90 rupees. Now, this is very common and very feasible. And the reason that the contracting price might be higher than the market price is because there is an element of a control premium. For those who are not aware of the concept of a control premium, it's effectively a higher price which is paid because the purchaser can buy a larger chunk of the company, and with that chunk is also now getting control of the company. So the extra 10 is a control cost that is being paid by the purchaser. Now let's assume this law wasn't in place. What would be the option for a public shareholder who was not happy with this transaction, or who felt that, look, with Mr. Orange coming in, I don't want to remain invested in this company? The only option at that time was to sell on the market. Now, if you want to sell on the market, the only price available to you is the market price, which is 90 rupees in our example. So while Mr. Apple receives 100 rupees for selling his shares to Mr. Orange, the public shareholders, for no fault of their own, would receive a lesser price of 90 rupees. And that's where this law comes in, to protect those public shareholders. What the law says is that if Mr. Apple is receiving 100 rupees for this transaction, then the public shareholders should receive 100 rupees as well. And that is the minimum guaranteed price that they get. The second rationale is that a public shareholder should have the right to exit his or her investment in a company if he or she is not comfortable with the new incoming shareholder or promoter. Now let's understand this with an example. Let's assume that I own Tesla stock. And the reason that I've invested in Tesla is because I believe Elon Musk is a great engineer. I think he understands manufacturing. He's a smart CEO, and maybe someday he's going to change the world. But tomorrow, if Elon Musk decides to sell his company to, say, Samir, I would be concerned. While I can vouch for Samir's skills as a lawyer, I'm not so sure about his engineering skills. And in that case, what the law provides is that I, as a public shareholder who had no say in this transaction between Elon and Samir, I have the ability to exit my holding at the cost that a purchaser pays, at a minimum guaranteed price, if I don't like the change in guard. And that is a great law to have because it protects the interest of all public shareholders. Next slide, please. In its most fundamental form, private and public M&A are very similar. The foundation stones remain the same. You deal with primary or secondary acquisitions through a share subscription or a share purchase agreement. You have a governance right or a shareholders agreement for the inter se relationship going forward. But where the difference creeps in is on account of the public shareholding and the various SEBI regulations. Now, we try and understand this with a very simple case study. The first case study that you see is of a private company deal, where the parties have contracted simply to sell 40% at a cost of 40 rupees. There is no element of a public shareholding, so that does not apply. So ultimately, a buyer and seller have mutually decided that they will enter into a contract for 40% stake at 40 rupees, and they're free to execute it without any complications. That's your private M&A deal. Of course, there are elements of a price adjustment because of diligence, etc., but those apply to both private and public M&A deals. Now let's apply the exact same situation, the exact same case study to a public market transaction. The buyer and seller agree to enter into a contract for 40% stake at 40 rupees. Now, because this is a substantial stake, which is more than 25%, the acquirer in this case is required to make a mandatory tender offer and acquire a minimum of 26% or offer to acquire a minimum of 26% from the public shareholders. So now from a deal size of 40%, the potential deal size increases to 66%, which is a sum of 40 plus 26% for the mandatory tender offer. The overall cost of doing this transaction has increased from the earlier 40 rupees to an additional 26 rupees and leading to an aggregate of 66 rupees. Now, when you think of numbers such as 26 rupees, 30 rupees, it's quite simple and non-controversial. But apply this to a real life public M&A deal situation where the values involved would run into hundreds of crores and millions of dollars. Suddenly the difference between having or not having a mandatory tender offer could be the difference between having a deal which is commercially viable or having no deal at all. Next slide, please. The second difference between a private and public M&A transaction is on pricing. Now, this is the same slide we discussed some time back, and we get into this in a little more detail now. As we discussed, and a quick recap, if a listed company is doing a preferential issue of shares, they need to factor in the historical pricing. So if a company, for example, wants to do a preferential issue on X day, or the board approves a preferential issue on X day, you would look back to the 90-day or 10-day volume weighted average, and the higher of the two would be your base price. Now let's apply it to the example we have before us. Let's assume in this case that the parties entered into a term sheet on the 1st of February. Now, if you see the pricing of this stock from January to February, and let's take a smaller threshold for now, it's hovering somewhere in the range of the mid to high 40s. Now, because it's in the range of the mid to high 40s, the minimum price at which the preferential allotment can be done is going to be around a 45 or a 47 rupees. And so parties are free to enter into a non-binding term sheet at 50 rupees, which is the expected price for them. Now let's assume that between the term sheet to the actual deal signing, where you typically have your negotiation of your transaction documents, your due diligence, etc., you have a period of say 10 days or 20 days. We've taken two examples. Say you sign the transaction on the 11th of February, or you sign the transaction on the 19th of February. Now, what we see is that there is a substantial stock price increase in that period. And the minimum price, which is a look back of 10 days or 90 days, and the higher of the two, will likely result in the price being much higher. So if we take an example of the share subscription agreement, the binding document being signed on the 11th of February, in all likelihood, the price has now moved to the range of 70 rupees. So while the parties are still commercially agreed and aligned to do this transaction at 50 rupees, they have a term sheet at 50 rupees, the law will not allow them to do the transaction at 50. The minimum price at which the transaction can now take place is 70 rupees. And this is the impact that dynamic pricing has on public M&A deals. And this goes back again to the mantras that we discussed: confidentiality and speed. If those two are achieved, you could typically try and execute your transaction in a quick manner without the price running away. Next slide, please. We now come to mandatory tender offers. We've discussed the concept of a mandatory tender offer. It exists to protect public shareholders. We've discussed the rationale twofold. We've also spoken of the pricing that you have in case of public M&A deals. Now, a mandatory tender offer is triggered under three circumstances. The first is if an acquirer purchases 25% or more securities or voting rights in a listed company. The rationale for the 25% is that at 25%, a public shareholder or any shareholder gets certain rights which are guaranteed in law. So for instance, anyone holding more than 25% is able to block a special resolution. Now, because this threshold is breached and the shareholder has certain inherent rights, the regulations require that the acquirer must make a mandatory tender offer and offer to the public shareholders to buy their shares. Now, it is entirely up to the public shareholders on whether they choose to sell their shares or not. The second trigger is referred to as a creeping acquisition. What this effectively says is that if an acquirer already has more than 25%, then they have a limited headroom to which they can acquire in each financial year. So if an acquirer has, say, 30% stake, he can only acquire an additional 5% in a financial year and not go beyond that. The rationale for this is that the regulations require you not increase your stake substantially in a single financial year. Of course, you could, but you would be required to make a mandatory tender offer. So you have a 5% creeping limit where you can slowly up your stake without the requirement of a tender offer. The third trigger, and perhaps the most interesting one, is control. Now, control is defined broadly under the takeover regulations. It has two key elements. The first is a subjective, the second is an objective. The objective element is that you're considered to be in control if you have the right to appoint majority of the board of directors of a listed company. The subjective is that you have control if you have the right to control the operations and policy decisions of a country, of a company. And this could be through contract, for example, a shareholders agreement, or through any other means possible. So in theory, you could have control of a listed company by owning very few shares or even no shares at all. Now, what are the ways in which you could get control of a listed company? One way is through signing a contract containing affirmative vote rights or veto rights, as they are called. Now, through several case laws, SEBI has explained veto rights and the type of veto rights which would constitute control and which would not constitute control. These are broadly classified into two buckets. One is the protective veto rights, which are not control, and the second is the participative veto rights, which are control. Protective veto rights are effectively rights that an investor or a shareholder gets to protect its investment. For example, a veto right which would require the company to take prior consent of an investor if the articles of the company are being amended to the detriment of this investor or shareholder. Whereas a participative veto right is, for instance, if the company is required to take the prior consent of the shareholder or investor for its business plan or for the appointment of its MD or its CEO. Now, in that situation, what SEBI says is that if you're participating in the operations and management, which you are doing because you have a say on the business plan, you have a say on who the CEO or the MD is, then you are seen to be in control. And if you are in control, you must make an offer to the public shareholders because they have the right to choose whether they want to continue in this company or want to exit. Now, these triggers deal with a direct acquisition of shares or voting rights or control. But a thumb rule that applies to SEBI regulations is that what you cannot do directly, you cannot do indirectly either. And therefore, each of these thresholds also applies to an indirect acquisition of shares or voting right, or an indirect acquisition of control. Next slide, please. We now deal with the broad timelines linked to a mandatory tender offer. Now, this is a lot. The timelines are highly regulated and time bound. I will not bore you with the entire set of timelines set out here. I will give you a very high level and brief summary so that you are aware of the key steps. Prior to launch of an open offer, what we typically do is all the documents are drafted and ready. You do not wait till the launch to actually put anything in place because, as I said, everything is time bound. If it is not done within a specified timeline, you're effectively looking at a breach of the regulations. The process broadly entails making a public announcement on the same day that you sign the underlying transaction, which triggers an open offer. This public announcement is a simple document. It's short, containing only the names of the parties, the underlying transaction, the price at which the deal is happening. This is followed by a detailed public statement. As the name suggests, there are more details in this document. It's a build-up on the earlier public announcement. You have details about the acquirer, the target, the parties involved, more details about the underlying transaction, the key terms of the agreement. And that is followed by the draft letter of offer. This again has even more details than the detailed public statement. The draft letter of offer is what is submitted to SEBI for its review. And SEBI assesses whether all conditions of the takeover regulations have been well complied and gives its observations and comments on the open offer process. Once SEBI's comments are received is when the parties move to tendering. Now, tendering is the phase where the public shareholders actually get the right to sell their shares. Tendering is normally done on the floor of the stock exchange. This is where a public shareholder would normally go to its broker and ask him to sell the shares on the exchange through the settlement process. This is open for a period of 10 days. One of the interesting things to keep in mind is once you tender your shares, you can't get it back. So it's important to take that decision in an informed manner. So while it's open for 10 days, once it's in the system, it stays there. Next slide, please. We now move to certain key characteristics or key principles that we see in public M&A deals. The first is on withdrawal of open offers. Once an open offer is launched, it's quite difficult to withdraw it. We often refer to it as Hotel California. So you can check in anytime you like, but you can never leave. So in non-pretentious lingo, what that means is that once you've launched an offer, unless you have certain very limited grounds, for example, you don't get a regulatory approval. So the RBI or the Competition Commission refuses to grant you approval to complete an underlying transaction, you are not allowed to withdraw an open offer, and you must go ahead and complete the transaction. So for instance, if you signed a transaction, launched an open offer, but because of certain diligence findings or because of there being a change in the global markets, you decide that this deal, the underlying transaction, is not commercially viable for me anymore, and I want to withdraw. SEBI will allow you to withdraw the underlying transaction. You can choose not to complete it, but the open offer itself must be completed. And now, what is the rationale for that? The rationale is that SEBI says that once you made an open offer, you have already impacted the market. The stock price has already moved up or down. And once you have impacted the market, you must go ahead and complete the tender offer process, which entails offering to the public shareholders and let them choose whether they want to sell to you or not. And if they choose to sell, you must buy. The second is on the offer size and the offer price. We already discussed that the minimum offer size is 26%. The offer price is linked to the contracting party's price or the historical market price. So for example, the Mr. Apple and Mr. Orange example we took. So if they have contracted at 100 rupees, then one of the parameters to determine the price is 100 because that is the agreed contractual price. But let's say that in the last 60 days, which is one of the other criteria, the weighted volume average price of the stock was higher than 100 rupees. So the market price was higher than 100 rupees. In that case, the higher of the two would be taken into account, and the public shareholders would be able to sell at the highest price between the two. We now discuss some aspects of the insider trading regulations. The insider trading regulations are a very important part of the public M&A regime. We have not dealt with it in a lot of detail here because that's a universe in itself and maybe a discussion for another time. But in brief, the insider trading regulations define the sharing of unpublished price-sensitive information. It stipulates that any unpublished price-sensitive information which is shared must be done with the approval of the board of the listed company and under the cover of a non-disclosure agreement. The regulations also prescribe that any person who has access to unpublished price-sensitive information, the details of such person are to be recorded in a digital database. So the name of the person, the identifier, for example, their PAN card, the date on which they got access to the UPSI and the nature of UPSI, all of this is to be maintained. Now, fun fact on this, the reason that this is done is because if in the future SEBI needs to investigate any insider trading, they have this data readily available. In the past, whenever SEBI would try to investigate insider trading matters, they would typically reach out to the company and ask for this information. It would take months and you would not get apt information. So now this has been preempted, and all listed companies and intermediaries who are required to handle unpublished price sensitive information are required to maintain a structured digital database ready for SEBI to have access to if required. Next slide, please. I thought it'll be interesting to talk about hostile takeovers, and this cartoon was a very apt description of the reality of hostile takeovers in our country. The media image of a hostile takeover is, on the war front, depicted here by our military man holding a gun, whereas the reality is a bunch of bald, aging lawyers sitting in a conference room trying to tie up a deal together. But to understand hostile takeovers, the hostile takeover regime does not have a predefined or a separate set of regulations which guide on a hostile takeover process. Hostile takeovers are based on the principle of freedom to acquire shares or control of a listed company. So in effect, what that means is that any person who has the means has the ability to try and acquire, control, or shares of a public listed company. This is what is referred to as an unsolicited tender offer. So today, if I have the means, I could go out and announce to the public that I intend to take control of a listed company. And the public would have the opportunity to sell their shares if they so wish. Now, India has seen several cases of successful and unsuccessful hostile takeovers, and most of them have been built on the basic principle of shareholder rights and shareholder democracy. A shareholder is free to buy and free to sell when they please. That is the end of my presentation today. Thank you so much for taking the time to listen in, and I'm open to any questions that you might have.
Very well done. And now that you had your sip of water, we'll go back to the Q&A. So we have a which says that you mentioned a minimum of 26%. What's the maximum that you can acquire in a tender offer?
Right. So the maximum that you can go up to in a tender offer is effectively ask for the entire public float. A little background, typically in a listed company, you have a minimum of 25%, which is required to be the public float. And we have seen cases where, up to 95% is public shareholding. So the ideal mix is that you buy as much, you're free to buy the entire public stake, but there is a requirement for you to sell it down to ensure that a minimum of 25% still remains as public float. So if you have, say, a 40% public outstanding, you could make an offer of 40%, but with the knowledge that you might have to sell down later.
Understood. I think there's a fairly basic question, but let's address it nonetheless. What are the penalties for missing a tender offer or a public announcement obligation?
Yeah, okay, so this happens more often than you would think, especially in the context of global transactions where multinationals have done a transaction in European jurisdiction, but they have an Indian listed subsidiary. And if you remember, one of the points we discussed was an indirect acquisition or change in control. So we have had cases where a global deal has happened without the Indian segment realizing that an open offer has been triggered. And usually what you see is the penalties are in the form of monetary penalties, and they are substantially high. But what can be done is once you realize that you have missed making an open offer, you can approach SEBI, go for a settlement, where typically SEBI will ask you to pay a fine to settle the non-compliance, but at the same time will also ask you to now complete the tender offer process.
Understood. Okay, so that I had another question on indirect acquisition. I think you've dealt with that. Now there's one on, are all forms of acquisitions of control covered by the tender offer obligations, or are there some exceptions?
No, there are certain exceptions that come into play, and most of these exceptions are fairly logical. So what we've discussed so far on the triggers is if somebody is acquiring, say, 25% or more of a listed company, they need to make an open offer. But let's imagine a situation where a shareholder transfers its holding to one of its wholly owned subsidiaries, or one promoter group company transfers to another promoter group company. Now, in all these cases, there isn't a change of control. It's effectively the shares or the voting rights moving from one hand to the other, and they're controlled by the same person. So the law provides for certain general exemptions, as they are called, which permits transfers above thresholds as long as they qualify. For example, subsidiary and holding company.
Understood. So let's say you mentioned there's a list of statutory exceptions. Let's say I don't fall squarely within the language of the exception, but I feel I have a case on merit, or let's say a case on spirit. Is there a way for me to approach SEBI, or do I have to go ahead with the public announcement and the tender offer nonetheless?
No, certainly. So that's a very good question, because we see this quite commonly as well. And one of the prime examples is acquisitions by trusts. So for example, family trusts. Now, as I'd mentioned, there are very specific qualifying entities between which transfers are exempted. And as Amir said, if you're not one of those qualifying entities, then SEBI does give you the freedom to approach SEBI and make your case and tell them why an exemption should be granted. So you're able to submit an application, SEBI scrutinizes it and grants you a specific exemption based on which you can complete the transfer without triggering a mandatory tender offer.
Understood. And typically, how long do these exemptions take, and how do you address confidentiality, one of your key mantras?
Right. So the timelines on these vary. I can tell you that I have seen some come through in 2 to 3 months, and I have seen some which have taken more than 12 to 14 months. A lot depends on the complexities involved. Anyone who's dealt with listed companies and how they are held would know that you have a web of inter-se holding. You know, you'll have 40 to 50 companies intertwined and then finally sort of holding the stake. And what we do in our structuring is try to clean this up and make it a simpler structure. So this all needs to be explained to the regulator. So the timelines vary. Confidentiality is another matter where you can request for a confidentiality, but ultimately this order is made available in the public domain. So at some point or the other, all the details that are available that you've put out will be known to the public. So that you have to be mindful about when you're making this application.
And just as a point, let's say there is an exemption given in a set of facts, and I am, take Apple and Orange. Mr. Apple got an exemption. I am Mr. Orange, who has got a very similar set of facts. Does the exemption given to Mr. Apple apply to me as a precedent?
Intuitively, the answer should be yes, but as it turns out, the answer is no. So what SEBI is very clear on is that their views are very specific to facts. Now, this is also because these views are taken at a particular point in time, depending on what SEBI's policy agenda is, their direction is, and no matter how well or how similar the facts are, there are always differences, there are always nuances. So SEBI makes it clear that any guidance, any exemption given is for a particular set of facts. If somebody else intends to do it, they must come to SEBI again, and SEBI will reassess on the facts presented to them.
Understood. So just going back to what you said on the sell down obligation. So let's say if the acquirer acquires more than 75%, then they have an obligation to sell down in a certain time period. But again, that's a distraction, because that means as soon as you buy the company, you not only have to run it, but you also have to worry about selling down to that. Is there some fix for this? Is there some way to avoid going above 75%?
Correct. No, and there is a recent amendment that has come into play which helps with this, but I'll take 30 seconds to just expand, Samir, which I think was a very good question. But one of the reasons that this is also problematic of buying more than 75 and then having to sell down is because typically you'll buy at a higher price. And when you're trying to sell down, you will lose money. So not only is it a legal problem, but even commercially, you always end up losing money in doing such a transaction. And to solve for this is something that had been presented to SEBI several times. We as a firm have made several representations to SEBI on this, and on representations, of course, made from industry bodies, law firms abound. There has been a recent amendment which has been made to the SEBI regulations, which effectively says that parties are now allowed to proportionately buy shares in their underlying transaction and in the tender offer, such that the overall holding of the acquirer does not breach 75%. So to take an example, if you sign a contract to buy 60% of a listed company, and now because it's 60%, you trigger a mandatory tender offer of a minimum of 26%. So if you were to buy your 60% plus your 26%, you'd look at an 86% stake. What SEBI has allowed now is that you could proportionately reduce the acquisition in your underlying transaction, which is a 60%, and in your tender offer, such that the aggregate is at 75, and you don't have to undergo the process of a sell down.
Understood. Just going back to your earlier point, you mentioned something about a guidance, and there's a linked question that if there's a gray area under the regulations, should informal guidance be used? How effective is it? again, confidentiality and so on. Do you want to just complete the loop on that one?
Sure. So informal guidances are a great way to get clarity on SEBI regulations. As is the case with most laws, they can be read in several different ways. And it's best to go to the regulator and ask where their mind is, because really, if you get it wrong, then they are the ones who will be interpreting it, and you'd have to justify it to the regulator. So an informal guidance is a great way where you can set out your facts, present your analysis on how you believe it should be read, and SEBI confirms it or tells you their position on how they believe it should be read. Now, an informal guidance is effectively just a guidance. It's not binding on SEBI or the parties, but there is a great degree of comfort that it provides. You can request for confidentiality, but again, this is for a limited period. And finally, this is made available in the public domain.
Understood. So we spoke about a situation of how with all things listed company, there tends to be a one-way street. So you can go from a private to a public listed company. There's a process, no problem. But suppose you want to go the other way. You want to, I'm an acquirer. I'm Mr. Orange. I want to buy Apple's company Green, and I want to take it private. Is there some process by which I can acquire it and try and work the take private at the same time?
Yeah, that's a very good question, Samir, and one that has recently seen a regulatory change. So since it has been a recent change, let me take you through both the old regime and the new regime. So the background is that a lot of acquirers, when they're buying a listed company, they see a lot of value in the listed company, but they want to take the company private because one, obviously you get 100%, or you could get 100% stake in a private company. Your compliances are reduced, your cost is reduced, you can run it in a very different way. So what the law provided earlier was that if you intend to acquire a listed company and take it private, you could launch a combined open offer cum delisting, which entailed launching an open offer and then putting the open offer on hold and then going for a delisting process. And in the delisting process, the public shareholders had the right to quote what they thought was a fair price for the stock. It's a process called reverse book building. Now, this process is something which is not very helpful from an acquirer perspective, because at times you will have public shareholders quoting obnoxiously high prices. It's a free pricing model. And therefore, we didn't see many successful cases of a combined open offer cum delisting, because if the delisting then failed because the price was too high or the 90% threshold, which is a delisting construct, is not achieved, then you had to come back and reactivate the open offer. And in this process, because of the delays on account of the delisting, there is an interest cost that needs to be borne, by the acquirer. Instead, the new regime and the new regulations provide for a much more simplified process. In this process, you launch a combined open offer cum delisting, and the process for the open offer and delisting run in parallel. And the best feature is that there is no price discovery or a reverse book build for the delisting. The acquirer himself has the ability to offer a premium price. So for example, if the underlying transaction has taken place at 100, and let's assume the open offer is at 100 as well, the acquirer can make an offer to delist at say 125, because they believe that 25 is a fair premium to take the company private. Now, if enough people tender, the 90% threshold is met, the company is delisted. If that is not the case, all those shares are effectively tendered in the open offer, and the open offer process is completed, thereby making this a much simpler process to undertake.
Understood. Okay, so maybe now we switch our hats. We've been talking about everything from the acquirer's perspective and the Hotel California syndrome. Let's say I'm the public shareholder, so I know the price. I've tendered my shares. Can I withdraw? Can I take my shares back subsequently?
Yeah, so I did touch upon this, and the reason I touched upon this during my presentation was this has actually happened in one of our deals. The answer is that once you've tendered your shares in a tender offer process, you cannot withdraw it. What happened in one of our deals was midway through the tender offer process, the stock price moved up substantially. So somebody who tendered on day one realized that midway, the price was way above the open offer price. So just to take an example, the open offer price was say 100, the stock was trading at 90 rupees, but during the tendering period, the stock price went up to 150. So effectively, the person who tendered in the open offer at 100 could have just sold it on the market for 150. And they actually called us saying that, look, I've tendered it, I want my share back because I'm going to sell it on the market. But unfortunately, once it's in, it can't get out. So the shares stayed there. And we, of course, had a few unpleasant conversations, but that's what the law is. And they had to continue with the tendering.
Understood. So maybe then, speaking of unpleasant conversations, we've got a very interesting fact set. So the question is it possible to make control, pardon my language, or fully acquire a public company if there is a reluctant shareholder owning 51% of the company's ownership? I think it's coming from the hostile takeover discussion. So you have a 51% controlling shareholder who's not willing to play ball. What do you do then?
Correct. Okay. So if you have a 51% stakeholder, they are obviously in a much better position to try and ward off a hostile takeover because they have the ability to control ordinary resolutions. And in that case, the ability for a hostile takeover is drastically limited. You will see hostile takeovers more commonly where the promoter has a substantially lower stake, where an incoming shareholder or investor can go up to a percentage of say 50 or 51. Now, what's also interesting to keep in mind is that in a listed company, you never have 100% voting turnout. There will be a huge chunk of public shareholders who don't show up to vote. So even if you had a 40% stake in a listed company, that could effectively help you control the listed company. But to answer your question simply, with a 51% already held by an existing shareholder, it's tough, but you could creep up by up to say a 30% and make life very difficult for the existing promoter. And that would usually bring the promoter to the table because you would create issues in getting any special resolution passed, bring operations to a standstill, and ultimately, who has more to lose? The person who has a higher stake. So it's not in the interest of the 51% holder to let the company be driven down as it is, as is the case for you, but their stakes are higher. So that's how you you can't automatically take control, but you can force the majority shareholders to come talk to you about joint control or an arrangement that you can enter into.
Great. You spoke about veto rights and participating and protective veto rights. Can you give some examples? And you mentioned there was some case law. Is something worth mentioning here?
Correct. So protective and participative rights and case laws have had a long and checkered history. So it started with Shubkam, and there have been several cases in between to NDTV, which was the most recent one. We've recently authored an article on control, and we'll see if we can include it in the pack that goes out to all the participants, which sort of analyzes the history and the current position on control. But some of the examples of protective rights are, say you want to amend the articles of the company, or you want to transfer a material undertaking. You want to change the nature of business that is being done. So if you're an investor, you've invested into a company which is a manufacturing company, and now suddenly from manufacturing, they want to become a finance company. That might be detrimental to the interest of a public shareholder because they were investing in a particular type of company. So those are seen as protective. Participative would be if I have a say on the business plan. The business plan would include my capital expenses, my expansion. If I have a say on all of that, I effectively have a say on the operations and management of the company, or who I hire or who the company hires as the CEO or the managing director. Now that is the person who's spearheading the company. If I control the spearhead, then I effectively control the company. But what's important here also to remember is that there is no thumb rule on this. There is no litmus test that applies. The rights package is always analyzed in totality to assess whether the completion of all the rights together give you control, whether they are in the realm of participative or protective. And that is always an individual analysis. We cannot have a one brush rule applied to all the rights.
Or let's say if Tesla were to decide to make me CEO, and that's something which you would definitely want to protect against. So with that, thank you, Abhishek. We come to the end of the Q&A. Ladies and gentlemen, unfortunately, we weren't able to take all of your questions. We are already overshooting time as I can see it. But we will, of course, make every effort to respond to each one of your questions offline. And as Abhishek said, we'll also send some additional materials across. Before concluding, we would request each one of you to respond to the poll slide on your screen to provide your feedback on today's webinar. We take this very seriously as a part of our continuous improvement. We will also separately send you a request for your feedback. The form takes less than a minute to complete. It really provides us invaluable insight on future activities. So with that, thank you to everybody who participated in the poll. And perhaps I'd like to summarize some of the key takeaways from today's webinar. Speed and confidentiality is an absolute key to conducting and, more importantly, completing public M&A. And M&A is a lot about process in general, but no other form of M&A is as process-driven as public M&A. Listed companies bring with them certain economies of size and scale, and hence the opportunity. But as a result, the multiplier on mistakes can be tremendous. Therefore, one cannot overemphasize the importance of having quality and experienced and expert advisors on your side. So finally, I would like to thank Abhishek for such a fantastic presentation, and also you, our audience, for your attention and your overwhelming participation. We hope you found the webinar interesting and a worthwhile investment of your time. We certainly, as always, enjoyed bringing it to you. Also, please do not hesitate to contact us regarding any matters arising from this webinar. Our contact information is on the contact slide at in front of you. And thank you once again for your attendance. We look forward to being of service again at future webinars.
Thank you, everyone.